Hey everyone, and welcome back to the channel. Ever feel like the stock market is just one big casino where you're destined to lose? What if I told you there is a way to invest that is less like gambling and more like owning a successful business? If that sounds good to you, then you're in the right place. Today, we're diving deep into the Bible of investing, The Intelligent Investor by the legendary Benjamin Graham. Before we jump in, if you're ready to transform your financial future, do me a huge favor and hit that like button, share this video with a friend, and make sure you're subscribed so you don't miss out on more game-changing content. Let's get started. Benjamin Graham, who was actually Warren Buffett's mentor, wrote this book to draw a clear line between investing and speculating. He wasn't about chasing hot stocks or trying to time the market. His whole philosophy is built on a simple but powerful idea: view stocks not as ticker symbols, but as ownership in actual businesses. This mindset shift is the foundation of everything he teaches. He asks you to stop thinking like a trader and start thinking like a business owner. Would you buy an entire company without doing your research just because its price went up yesterday? Of course not. So why would you do that with a stock? This brings us to one of Graham's most famous concepts, Mr. Market. Imagine you have a business partner named Mr. Market. He's a bit moody. Some days, he's euphoric and offers to buy your shares for ridiculously high prices. On other days, he's panicky and offers to sell you his shares for dirt cheap. The intelligent investor doesn't get swept up in Mr. Market's mood swings. Instead, you use them to your advantage. When he's pessimistic and offering you a bargain, you buy. When he's overly optimistic and offering you a crazy high price, you can consider selling. You are in control, not him. You don't have to trade with him just because he shows up. This allegory perfectly illustrates the importance of emotional discipline and not letting market noise dictate your decisions. So, how do you know if Mr. Market is offering you a good deal? This leads to Graham's core principle, the margin of safety. This is the bedrock of value investing. The margin of safety is the difference between a company's intrinsic value, what it is truly worth, and the price you pay for its stock. Think of it like building a bridge. If you calculate that a bridge needs to hold 10 tons, you don't build it to hold exactly 10 tons. You build it to hold 15 or 20 tons. That extra capacity is your margin of safety. In investing, if you determine a stock is worth $50, you don't buy it at 49. You look to buy it at 30 or 35. This buffer protects you from bad luck, miscalculations, or the unpredictable downturns of the market. The wider the margin of safety, the lower your risk and the higher your potential for profit. Graham identifies two types of investors: the defensive investor and the enterprising investor. The defensive investor seeks safety and freedom from bother. They aren't looking to spend hours analyzing financial statements. For them, Graham recommends a simple, disciplined approach. This involves creating a portfolio with a balance of high-grade bonds and a diversified basket of large, prominent, and conservatively financed stocks. A classic Graham recommendation was a 50-50 split between stocks and bonds, rebalancing periodically. The key for the defensive investor is consistency and avoiding mistakes. Dollar cost averaging, investing a fixed amount of money at regular intervals, is a perfect strategy here, as it smooths out the bumps of market volatility. The enterprising investor, on the other hand, is willing to put in the extra time and effort to achieve potentially higher returns. This isn't about taking on more risk recklessly. It's about being more diligent. The enterprising investor might look for smaller, less popular companies or special situations like mergers or spin-offs. They'll do deep dive analysis into financial reports, looking for companies trading significantly below their net current asset value, what Graham called net nets. This is a more active approach, but it's still governed by the strict principles of margin of safety and thorough business analysis. It requires a lot more work, but for those with the passion and skill, it can be very rewarding. A huge part of Graham's philosophy is about what not to do. He warns against trying to time the market. Predicting short-term market movements is a fool's errand. Even the professionals get it wrong most of the time. He also cautions against growth investing in its popular form, that is, paying an exorbitant price for a company just because it's growing quickly. High growth is often already priced into the stock, leaving you with no margin of safety. If that growth slows even a little, the stock can plummet. Graham emphasizes that a low price is the ultimate source of a bargain. He taught that you should focus on the price you pay, because that's one of the few things you can actually control. So, how can you put this into practice today? Here are some actionable steps. First, define what kind of investor you are. Are you defensive or enterprising? Be honest with yourself about the time and effort you're willing to commit. Second, embrace automation. Set up automatic investments into a low-cost, diversified index fund. This is the modern equivalent of Graham's advice for the defensive investor, and it puts dollar cost averaging to work for you. Third, start learning to read financial statements. You don't need to be an accountant, but understanding basic concepts like revenue, earnings, and debt will empower you to assess a company's health. And finally, and most importantly, practice patience and emotional control. When the market panics, remember Mr. Market. See it as an opportunity, not a catastrophe. Don't check your portfolio every day. Think in terms of years and decades, not days and weeks. The key takeaways from The Intelligent Investor are timeless. 1. An investment is most intelligent when it is most businesslike. Treat stocks as businesses. 2. A true investment must have a margin of safety. Always buy with a buffer. 3. Master your emotions. Be rational when others are fearful or greedy. And 4. Know yourself. Choose a strategy that fits your personality and your life. This isn't about being the smartest person in the room. It's about having the right temperament and a sound intellectual framework for making decisions. Graham's wisdom has guided generations of successful investors, not because it's a magic formula, but because it's a logical, disciplined, and sane approach to building long-term wealth. That's a wrap on our deep dive into The Intelligent Investor. This book is dense, but its core lessons are incredibly powerful and more relevant than ever in today's volatile market. Remember, the goal is not to beat everyone else, but to meet your own financial goals with a strategy that lets you sleep well at night. I'm so excited for our next video, where we'll be tackling another foundational book for your success journey. Thank you so much for watching. If you found this summary helpful, please hit that like button, share it with someone who needs to hear it, and subscribe to the channel for more content just like this. I'll see you in the next one.